Welcome to Griffonomics.
Good to be here.
Today, we are opening a case file on a company that, well, it feels like it's living a double life.
Mm.
I mean, if you were to drive past their facility or, look them up on a stock screener, on the surface, it looks like a standard 70-year-old industrial manufacturer.
The kind of company that's usually like the bedrock of a portfolio but doesn't exactly get invited to the cool tech parties.
Exactly. But when you peel back the layers, which is our whole mission for this deep dive, you find a company that is sitting right at the intersection of the two biggest, loudest, and most transformative trends in the global economy right now.
The big ones.
We are talking about the massive boom in AI compute power and the global surge in LNG energy exports.
It is a fascinating convergence. We're looking at Powell Industries, ticker symbol POWL.
Right.
And you're right, if you just glance at the surface, you see a traditional electrical equipment manufacturer.
Right.
But the deep dive today is really an investigative report into a pivot.
A pivot from the old world industrial model to something faster.
Yes. We're looking at a fundamental transformation. I mean, we're exploring how a custom engineering shop is morphing into a standardized manufacturing powerhouse.
How a company reinvents itself after 70 years.
And we aren't just speculating here. We've got a whole stack of sources for this. We're pulling from their Q1 fiscal year 2026 earnings reports, investor presentations, and the transcripts from just a few days ago, February 3rd and 4th, 2026.
So the mission is to understand the mechanics of that shift. How do you take a company known for being a custom tailor and turn it into a factory for the AI revolution?
That's the question.
And I love that phrase, rewiring the grid for AI.
Yeah.
So let's unpack this. Start us off with the business model, because this is where it all begins. You said they were like a custom tailor. What does that actually mean in the world of heavy industry?
So for decades, Powell's whole identity was engineered to order.
Okay.
If you were a petrochemical plant or a utility and you needed a massive, complex switchgear room to control your power, you went to Powell.
And for the listener who might not be an electrical engineer, and I count myself in that group, let's define switchgear. We aren't just talking about the fuse box in your basement, are we?
No, definitely not. Think of switchgear as the central nervous system for high voltage power.
Okay.
These are massive metal lineups, sometimes the size of shipping containers, filled with circuit breakers and controls that manage the flow of electricity. If these fail, the factory stops, or the data center goes dark.
So mission-critical infrastructure.
Absolutely. And historically, Powell built these as one-offs.
Every single one was unique.
Precisely. Every bolt, every wire customized for that specific client, which is great for quality. It builds an incredible reputation. But from a business perspective, it's slow.
And I'm guessing it's expensive to scale. You can't just press a button and make 1,000 of them if they're all different.
That is the bottleneck. You need an army of engineers for every project. But here's the key finding from the Q1 2026 data. Powell is actively building out what they call the product side of the company.
The product side. That sounds standardized.
It is, and that's the whole point. They're moving toward repetitive manufacturing.
Ah.
So instead of reinventing the wheel for every project, they're identifying specific electrical technologies they can build over and over again.
Okay, let me try an analogy. This feels like a chef who spent his career doing, like, private 6-course dinners. Highly specialized, very slow.
Right.
But now he's realizing, wait a minute, everyone just wants my signature burger. So he opens a high-end kitchen to pump out those burgers at scale.
That is a perfect analogy, and it explains the economic goal here. They keep talking about efficiency factors in the transcript.
Right.
When you build the same thing over and over, you get faster. Your labor hours go down. Your waste goes down.
You're not looking at the recipe code every time.
Exactly.
Yeah.
And your margins go up because you aren't spending thousands of engineering hours on unique designs.
Which gives you pricing power.
That's it. As those efficiency factors kick in, their ability to price competitively while keeping a bigger slice expands. And the sectors driving this are oil and gas, specifically LNG utilities, and the big one, commercial.
And commercial is basically code for data centers.
It's almost entirely data centers at this point.
Okay, let's zoom in on that. The strategic inflection point. This transition from old school industrial energy to the whole AI factory model. Why is Powell winning here?
It all comes down to the AI compute boom. The demand for power distribution to support that compute is just surging. You can't build a massive AI data center without massive, reliable power.
Right, because those AI chips, the GPUs, they're incredibly power hungry.
They are. The
Yeah.
density of power needed per square foot is just skyrocketing. That means the electrical gear has to be more robust, more complex, and that complexity plays right into Powell's hands even as they standardize.
I saw a stat in the earnings transcript that just blew my mind. The commercial and other industrial market is now 22% of their total backlog.
And within that, data centers specifically make up 15% of the total backlog. That's a record for them. It went from a niche business to a primary driver in, like, no time at all.
And it's not just data centers. The LNG side is booming too.
It is. LNG permitting resumed about a year ago, and we're seeing this funnel of projects that looks really strong. The U.S. is becoming the world's gas station, and Powell is building the pumps.
I want to touch on something else from the sources. Their tech stack, they bought a company called Remsdak.
Yes, Remsdak.
Sounds like a Bond villain.
Well,
I am Remsdak.
It does, doesn't it? But it's a UK-based company they got for about $16.3 million. And this is crucial. This wasn't just buying revenue, it was buying tech.
Okay.
Remsdak makes something called SCADA remote terminal units.
All right, break down SCADA for us, layman's terms.
Okay, so SCADA is supervisory control and data acquisition. Think of it as the brain of the electrical system.
The brain.
The switchgear POWL builds is the muscle. It does the heavy lifting. The SCADA system is the automation and software that lets you monitor and control everything remotely.
So Powell builds the muscle, and now with Remsdak, they own the brain.
That's the synergy, and they're already seeing traction. They are winning orders that integrate Remsdak tech into U.S. data center projects.
Wow, that's fast. Integrations like that can take years.
It shows agility. They're not just selling metal boxes anymore. They're selling a smart, integrated solution. And in a data center where uptime is everything, that's a huge selling point.
So they have the model, they have the tech. Let's talk about the moat, because talk is cheap, but bookings, that's real money.
The numbers are, they're staggering. In Q1 of fiscal 26, new orders bookings surged 63% year over year.
To what?
To $439 million.
In one quarter. That's the highest in over 2 years.
And the book-to-bill ratio is sitting at a very healthy 1.7x.
Okay, for the listener who doesn't speak finance, bro, what's a 1.7x book-to-bill mean?
Right, so a ratio of 1.0 means for every dollar of product you shipped out, you got a new order for $1. You're just treading water.
And Powell's at 1.7.
Exactly. For every dollar they build, they booked $1.70 in new work. They're filling the bucket much, much faster than they're emptying it. Future growth is almost locked in.
And these aren't small jobs. The sources mention mega projects.
Two specific wins really prove the strategy is working. First, their first ever mega project for a single data center. That one order was for about $75 million.
$75 million. For one data center, that's not just a couple of breaker boxes.
That's an entire power ecosystem. And on the LNG side, they landed a huge award, over $100 million, for a project on the U.S. Gulf Coast.
So when you add it all up, the backlog hits a record.
$1.6 billion.
Wow.
And so what here is visibility? Management said this gives them visibility all the way into fiscal 2028.
That's a huge safety net.
It's a massive moat of secured work. They know what they'll be doing for the next 2 years. They aren't guessing if the phone is going to ring.
Okay, so everything sounds perfect. But then we get to the earnings report from February 3rd, and we see what I'm calling the Q1 FY 2026 paradox.
The paradox. Yes, the headlines were confusing.
Right. They missed on revenue, but they crushed earnings. How does that happen?
Let's break it down. Top line revenue was $251 million. The estimate was around $257 million.
So they sold a little less than expected.
Slightly. And that was mostly a decline in the petrochemical segment and just typical seasonality. Q1 is always slower.
But despite selling less, they made way more profit.
This is the magic of margins. They reported record Q1 adjusted EPS of $3.40.
And Wall Street was expecting.
Consensus was only $2.85. They beat it by a mile. Net income up 19%.
So walk us through the mechanics. How do you make 19% more money on lower revenue?
It all comes down to gross margin. It exploded to 28.4%. That's up 380 basis points year over year.
That is a huge jump in the industrial world.
It's massive. It comes from strong project execution and what they call favorable closeouts. They're executing so well, they're getting paid for efficiencies. They're not leaking money on mistakes.
So the takeaway is they aren't just selling more. They are selling better.
Exactly. And the pricing environment is stable. Demand is so high, they don't have to put their product on sale.
And this all leads to the concept of operating leverage.
Mm.
This is where the financial engine really starts to purr.
Right. Think of it as earnings velocity. Because their fixed costs are controlled, every extra dollar of revenue drops more profit to the bottom line. Earnings are projected to grow faster than revenue for the next 4 years.
We saw that in the SG&A numbers too.
Yes, SG&A selling, general, and administrative expenses, it's declining as a percentage of sales. They are getting leaner as they get bigger.
Okay, I have to play devil's advocate here. It can't all be perfect. What are the risks? The short-term friction.
There is friction. It's not all smooth sailing. The biggest challenge is labor, specifically skilled labor shortages in engineering.
I can imagine that's a bottleneck. You could have all the orders in the world, but if you don't have the engineers to design the systems.
That's the primary constraint right now. An electrical engineer who understands high-voltage switchgear is a very hot commodity.
And materials.
Always a potential risk of rising prices, copper, steel, and, like we said, seasonality. But management seems to be navigating it all pretty well.
Let's talk about their balance sheet, because for a company this size, it's a fortress.
It is a fortress balance sheet. As of the end of 2025, they are sitting on $501 million in cash and short-term investments.
$500 million in cash.
Yeah.
And how much debt?
Zero debt.
That's incredible. So what are they doing with all that cash?
Well, they're deploying it strategically. They increased the dividend a little bit, about 0.9%.
Okay, conservative.
But more importantly, they are investing in capacity. The Jacinto Port facility expansion, that's a $12.4 million project, is on track for the second half of 2026.
To support the LNG wave.
Correct. And for the data center strategy, they're leasing new facilities. They added 50,000 square feet just to support inventory and production for this new standardized product line.
So they are putting their money where their mouth is.
Yeah.
Building the factories to build the products.
Precisely. It's disciplined capital allocation.
So we've looked at the pivot, the numbers, the cash. What's the final verdict?
It's the story of a quality compounder.
A quality compounder. Break that down.
Well, think about it. Powell is effectively decoupling from the old industrial boom and bust cycle. They're attaching themselves to these huge secular growth trends, AI and LNG, that will last for a decade.
It's like they looked at their business and said, we're good at the hard stuff, so let's just figure out how to do the hard stuff faster.
And that's the key. The investigative conclusion here is a BY, or long-term accumulate. The phrase that kept coming to mind was risk-defined, portfolio protected.
I like that. It's funny, you look at Powell and you see this, boring electrical company, but it suddenly became a tech infrastructure growth story.
But it's a growth story with discipline. That's the difference. They have the cash, the backlog, and the margins to weather any storm.
It really is impressive execution, moving a 70-year-old ship to catch the wind.
And doing it without springing a leak.
Okay, before we wrap up, I want to leave the listener with one last thought. We talked about this standardization strategy, the chef making burgers.
Yes.
Here's the provocative question. If Powell succeeds in standardizing these massive electrical components, does that eventually turn them into a commodity player?
That's the danger, isn't it?
Right. If everyone can just buy the standard Powell switchgear, does that premium disappear? Or does the sheer complexity of the grid, the fact that these things just cannot fail, does that keep their efficiency moat intact?
That is the multi-million-dollar question. Can you mass-produce complexity without losing the value of the expertise?
Something to think about. Thanks for joining us on this deep dive. Stay curious.